Walk through the financial districts of the world today, or scroll through the headlines on your phone, and everything looks unstoppable. Stock markets are pushing to record highs. Technology executives promise that artificial intelligence will redefine productivity, eliminate inefficiency, and unlock an entirely new era of profit. Governments celebrate massive spending bills marketed as permanent prosperity and economic strength. The message is repeated everywhere, in different forms but with the same confidence. This time is different. It feels like a golden age. Periods like this always do. History rarely announces its turning points loudly. Instead, it whispers them beneath optimism, growth charts, and reassuring narratives. The danger comes not when people are afraid, but when they are certain. In 1929, just days before the Great Depression began, the most respected economists in the world declared that stocks had reached a permanently high plateau. In 2000, analysts insisted that the internet had changed the rules of profit forever. In 2007, policymakers assured the public that nationwide real estate prices never fall. Each time the logic sounded airtight, each time the crowd believed it, and each time mathematics eventually overruled confidence. At the close of 2025, we find ourselves standing at a disturbingly familiar edge. The global financial system today is defined by a profound contradiction. On one side, markets are inflated by speculation, leverage, and belief. Valuations assume near perfection, growth is priced in before it happens, risk is treated as an inconvenience rather than a constraint. On the other side, the foundation beneath this optimism is weakening, weighed down by structural debt, aging liabilities, and consequences that have been postponed but not eliminated. The gap between perception and reality has rarely been wider. And inside this gap, a date keeps appearing quietly, repeatedly, and without drama across balance sheets, refinancing schedules, and corporate ledgers around the world. 2026. This is not a prophecy, it is a timetable. It is the year when trillions of dollars borrowed during the era of free money must be rolled over in a world where money is no longer free. It is the year when the excitement surrounding artificial intelligence collides with the unforgiving reality of margins, operating costs, and cash flow. It is the year when consumers, already burdened by inflation, high interest rates, and record debt, lose their remaining ability to absorb additional pressure. What we are facing is not a standard recession risk, it is a tail risk event. A scenario that appears unlikely right up until the moment it happens, capable of erasing years of market gains in weeks rather than years. Welcome to Echoes of Finance, where financial certainty fades and the numbers begin to speak for themselves. Today, we are not chasing daily market noise, reacting to headlines, or predicting short-term price movements. We are conducting a forensic audit of the global economy. Because to understand what is coming, we first have to understand why the system has not already collapsed. Right now, the global economy is being supported by three temporary pillars: government stimulus, artificial intelligence speculation, and consumer credit. Each of these pillars looks solid when examined in isolation. Each provides real, measurable support. Together, they create the illusion of resilience. But resilience built on temporary supports is fragile. Government spending has delayed pain, not removed it. Artificial intelligence optimism has inflated expectations faster than profits can realistically follow. Consumer credit has sustained demand, but only by pulling future spending into the present. All three pillars are weakening at the same time. And when temporary supports begin to fail simultaneously, systems do not bend gently, they snap. The cracks are already forming. They are simply not visible from the top of the market. If the system feels fragile, the obvious question is simple: why hasn't it collapsed already? The answer is uncomfortable. The global economy is not stable. It is suspended. Right now, everything is being held up by three temporary pillars. Remove any one of them, and the system weakens. Remove all three at the same time, and the illusion breaks. The first pillar is government stimulus. Over the last several years, governments did not allow the economy to clear. Instead of letting weak structures fail, they injected liquidity at an unprecedented scale. Deficits exploded, balance sheets expanded. Pain was postponed, not eliminated. In the United States, the latest fiscal package extended tax cuts, increased deductions, and removed entire categories of taxation. On paper, it looks like growth, more money in pockets, more spending, more confidence. But fiscal stimulus is not free. Every dollar injected must be financed with debt, and that debt carries consequences. Analysts now warn of fiscal reflation, the risk that government spending reignites inflation just as it was beginning to cool. If inflation accelerates again, the Federal Reserve cannot cut rates. It may be forced to keep them high or even raise them further. That brings us to the second pillar, debt. During the era of near-zero interest rates, corporations borrowed trillions of dollars. Cheap money encouraged expansion, acquisitions, and massive stock buybacks. It worked because servicing debt was effortless, but debt has a clock. Corporate bonds mature, loans expire, refinancing is unavoidable. And for a massive portion of the global economy, that clock runs out in 2026. Nearly 40% of global corporate bond debt is scheduled to mature within the next 3 years. Companies that borrowed at 2% now face refinancing rates of 5, 6, or 7%. Interest costs double. Sometimes they triple. For healthy firms, this means shrinking margins. For over-leveraged companies, it means survival becomes impossible. Profits disappear just to pay interest. Growth stops, layoffs begin, defaults follow. This is known as the maturity wall, and it does not care about narratives. Which brings us to the third pillar, belief. For the past 2 years, financial markets have been carried by the promise of artificial intelligence. Valuations surged on expectations of future dominance. Trillions of dollars flowed into companies building chips, data centers, and digital infrastructure at historic scale. But belief eventually meets accounting. 2026 is when investors stop asking what artificial intelligence might do and start asking what it actually earns. If revenue growth fails to justify the spending, markets will be forced to reprice reality. At current valuations, repricing is not a correction. It is a shock. And these three pillars are not independent. Government stimulus fuels inflation. Inflation keeps rates high. High rates make refinancing debt painful. Painful refinancing exposes weak companies. Weak companies undermine market confidence, and confidence is the only thing holding speculative valuations together. This is how systems unravel, not suddenly, but all at once. The economy is not crashing yet because these supports are still in place, but supports that depend on timing eventually fail when timing runs out, and timing is running out. In the next part, we will look at the mechanism that turns fragility into catastrophe, the signal that has preceded every major market crash of the last century, the force that transforms small declines into violent collapses, leverage. Systems do not collapse because people panic. They collapse because leverage turns small fear into force that the system itself can no longer control. For more than a century, every major financial crash has followed this same structure, across different decades, assets, and narratives, always driven by the same underlying mechanism, borrowed confidence. Leverage magnifies gains when prices rise, but when prices begin to fall, even slightly, it removes freedom entirely. Selling stops being a choice and becomes an obligation, and this is the precise moment when fragility turns violent. Today, markets are not merely expensive, they are expensive and deeply leveraged. a combination that removes stability from the system altogether. The danger does not announce itself loudly or arrive with panic. It begins quietly, through an unexpected report, a disappointing earnings call, or a geopolitical headline that shifts assumptions just enough to matter. Prices slip within what appears to be a normal range, yet that movement is sufficient to trigger margin calls, forced selling, and a feedback loop where selling itself becomes the driver of further declines. As this process accelerates, human judgment exits the system. Algorithms take control, liquidity disappears, and what began as a routine correction transforms rapidly into a crash. These events do not unfold because investors lose confidence. They unfold because the structure demands acceleration once leverage turns. The market does not negotiate. With no cash left on the sidelines and no buffer remaining to absorb shock, the system has no shock absorber. When the math asserts itself, it clears. For more insight like this, subscribe to the channel. If this analysis changed the way you see the system, ignite the like button. More breakdowns are coming.